We've had downgrades galore in Europe, but instead the market is going to focus on China today, and that's why we're up. I'm here with Mark Newton. He is the chief technician over at Gray Wolf Equities. So, you know, we've heard about China slowing. We've heard they're growing. What is it? Are they slowing or are they growing?
Well, we're starting to see signs of them slowing, but obviously they're still growing at a pretty torrid pace. But I think that seems to be the bigger picture. China's the bull in the China shop. You see potential for them to cut rates, which would be very beneficial, I think, for commodities, and markets have responded positively to that. So it continues to be more about what's happening outside the U.S. Equities have been resilient. Technically, we're still in a bullish uptrend. We're getting close to levels where we should start to stall out here. So I think over the next couple months, it's going to be really it's going to pay to be a lot more selective, and the risk reward is not nearly as good, I think, for equities. But for the time being, it looks like the S&P can probably get to near 1315 or so, and then we back off potentially into early February. The mean reversion trade continues to work. Last year's laggards like materials and financials continue to be the best performers. Even on today with disappointing news in financials, you're seeing financials up. And my thinking is even on slowdowns that those two sectors likely will lead in the next couple months.
I started out by talking about Europe and the downgrades. You mentioned that we've seen a kind of a disconnect between the euro and our stock market, where in the past when the euro was going down, we went down, but that isn't happening right now.
No, we've seen the correlation has started to break down pretty materially between the euro and the dollar and financial assets. In the past, pullbacks in the euro would be very bearish in the stock market would pull back, and really in the last couple weeks, over the last few months, the euro has pulled back, but yet the stock market has risen, and so that correlation is broken down. Draghi is given the indication that the ECB is going to do whatever it can to step in and try to save the euro, and so to some extent that represents gradual stabilization. I think if there's a little bit more confidence there, and the euro technically is setting up like it can begin to rally against the dollar and against some of the other major currencies, so that could be bullish. Right now it just seems like the dollar is due to pull back a little bit over the next couple months. It's had a bit of a run. Commodities are due to bounce a little more. Crude oil gets up to 105. That would be an area to take profits. Copper's been the bigger mover over the last week and has broken out above 350, and so that continues to show resilience too. So a lot of these are bullish for the material sector. You look at steel, you look what's going on in some of the mining and gold, and those are all very good sectors. Utilities is an area that's been one of the worst performers over the last month, but that's starting to show signs that could bottom out. So this next month, it's going to really pay to be selective in terms of what to buy. For now, you want to still own financials and material stocks.
All right, well, it sounds like overall we got a lot of bullish things coming out of you. That's Mark Newton over at Gray Wolf.